Hi, this is the RITE Report, and we're going to do an interim report here on February 22nd due to some special situations occurring in the stock market, possibly, and we're going to discuss that today. To begin with, I'm the author of 4 books on philosophy, one of which is the Philosophical Equations of Economics, and it can be seen at the philosophicalangle.com. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and Tufts, and he's an independent venture capitalist. Good to see you, Rick.
And you.
Approximately once a month we put out the RITE Report Show, but a special situation requires us to take another look at it here on an interim basis. And that is the possibility of inflation. And so let's just review here a couple of things before we make any conclusions. But we've noticed that in the RITE report, which came out on February 8th, that the high dividend bond with the symbol HYG was at 87.52, and it is now at 37, so it's gone down, and that has indicated that interest rates are on the way up. The positive number of economic indicators was pretty good in January, with 22 positive and 5 negative and 1 neutral. So things haven't changed pretty good, and it's a pretty good outlook for the near-term future. But the U.S. dollar index, the WSJ dollar index, was at 91.15 and earlier in February, and now it opened this morning at 90.32. Oil early February was at 57.57. It is now at 58.88 as it opened this morning. It's gone higher since then. Gold was at 1828 earlier this year, earlier in February, and is now, and curiously, has gone down to 1782 is where it opened up this morning. InflationData.com indicates that inflation early in February was 1.36, but that has their current indication is 1.40, and so inflation seems to be ticking up. The Crb Commodity Index, which is a group of 19 commodities, and that index a month ago, early in February, was 182.76, and since then has shot up to 200.44. The DJIA index is now at 31,381.12. I think that opened up this morning. So, although the CRB index at 200 isn't extraordinary, it's been there within the last 2 years, but not in the last, not recently, and it has shot up in the last month. So all this, we're all thinking about the possibility of inflation hitting the stock market and the possible rise of interest rates. And so if interest rates rise, of course, that will want to attract capital away from the stock market, and that could cause a downturn in the stock market. What do you think, Rick? Do you think that interest rates have gone up enough so that it'll attract capital away from the stock market in the near future? What do you think?
I don't know that they've gone up enough to attract an enormous amount of capital yet. I think what we've seen since the beginning of the year is a kind of classic rotation. Traditional industries are starting to get traction, automotive, oil and gas, and so forth. Coming off of what was last year a 40% decline in earnings per share amongst the S&P. I mean, that's a lot of ground to make up, but obviously, broader macroeconomic conditions are improving for not just tech, but also traditional industries, and are enormously better than last year. That goes almost without saying. That said, the stock market indices are quite a bit higher than 12 months ago. So valuations are stretched all over the place, and that's what makes this stock market, broadly speaking, so vulnerable. The tech companies are particularly vulnerable, but the broader indices are vulnerable, and it's at this point price for perfection, and perfection is rare. So my view, as I might have stated earlier, is that this is a trading market. You need to look for unloved industries and or entry opportunities when the market corrects. I think tech is going to be hard going from here forward because the valuations there are so ridiculously stretched. You'll probably have better luck looking at other more traditional sectors, and in what is becoming kind of a classic recovery in demand and production and so forth. I think there was an article today in the Journal suggesting that all this 1.9 trillion in COVID relief, it will not likely go into productive activity. It won't cause companies to invest in greater capacity or new facilities because it's viewed as a temporary phenomenon. It has to be a temporary phenomenon. I mean, hopefully we're not going to be spending this kind of money as a country, year after year after year. I do think the bond market is sending a signal, as it always does. It's always very sensitive to risk, and usually precedes the stock market and registering that sensitivity. And so the inflation risk is real. And in the meantime, let's be honest, there are whole sectors of the economy that are prostrate. There is no good news in the entertainment industry, at least in terms of luxury hotels, cruises, vacation spots, all those kinds of industries, dining. They're barely surviving and losing money, losing a lot of money. Airlines, Boeing's latest report indicated, $12 billion loss. Exxon had huge losses last year, as did all the oil companies effectively. I mean, so many of these sectors and firms are still in recovery mode, and even though conditions are vastly better than they were last year, it's still recovery mode. We're not forging ahead, expanding production. In fact, the oil companies have announced cutbacks in production, and that's got its own implications for inflation, because you may hail the rise in oil prices and as a signal of better economic times, more demand, more economic activity. But that, if they rise too much, that's got its own downside, right? I continue to believe the stock market is a trading market. There will be ample buying opportunities ahead. It has been surprisingly non-volatile up to this point, and I think that's all wrapped up in the COVID relief package and this assumption that there's just so much money to go around. It's got to find a place somewhere, and most likely that will remain the stock market as the first choice. And I buy that. But there's one other phenomenon I would mention in the context of tech, and that is that these special purpose acquisition companies are drawing a lot of interest, a lot of money, which is primarily invested in earlier stage tech stuff, a lot of electric vehicle, electric charging, and alternative energy. There's a ton of money going into earlier stage companies in these areas and other biotech and so forth. And that is drawing some interest away from the traditional tech heavyweights. So that's another effect that I think investors have to be aware of that are, overweight big high tech. And one other factor I'd mention is that, the world is noticing that other countries are recovering too. So there's going to be a tendency, the U.S. has been, the safest haven thus far, and our position in tech globally merits that perception. But other countries are going through the same reflationary recovery, and they will attract a certain amount of capital. So, European stock markets are flying, the Chinese market's doing very well, other Asian markets are doing extremely well. So, money will be invested there and not as concentrated in the United States as it's been over many months.
Okay, and I think that your point on the 1.9 trillion is well taken here. A majority of that is going to be inefficient money in that it won't go into research and investment in private companies, but will be going into the economy as welfare and government misspending. So although a certain amount may go in, I would say it's probably only 10 or 20%. But and so I think that if the Crb Commodity Index reaches past 220, I think we're going to see an explosion in interest rates, and that will take away from the stock market. But that has yet to be seen, and so I think we have to wait till next month to find out more about the possibility of inflation and the possible rise of interest rates. Rick, any final comments?
Stay very alert in this kind of a trading environment, because I think investors will have to, if they haven't sold out of tech already, they should be considering that and looking for entry points, and they should be considering, a sensible rotation strategy, given, the obviously reflationary conditions we're seeing in more traditional industries.
Okay, Rick, thanks for that, and we'll see everybody on the next report in early March.